VA loans are one of the lowest default rates of all types of loans. And what's the down payment requirement on a VA loan?
I,
Zero.
I,
I would say greed is one of the biggest mistakes investors make. I would say definitely it's worth sharing profits early on in your career to get a good solid foundation and the relationships you're trying to build. Look, they don't ask for down payments if you don't offer it. I mean, these are people that are motivated and you could help solve their problem. There's
right.
thousands and thousands of ways to fund real estate transactions. It's literally open to your creativity and what you and the seller both will benefit, how you can both benefit from the transaction.
Banks typically don't loan money to people that really need money.
You don't use a hammer to drive in a screw, right? You use the correct tool for the correct job. And hard money or private lending or whatever you want to call it,
Real estate development. Real estate development. Land to legacy.
Kevin, let's jump right into financing real estate. A lot of times we get calls from property owners with not enough experience that are trying to work on projects and stumble when it comes time to actually get the building out of the ground because they don't have enough track record. They don't know how to go about raising money, getting the right equity, getting the right debt. That sounds to me like you do financing and you know a lot
yeah.
about the world. Talk to me. What do I need to know?
Yeah, Eugene, thank you so much for having me on, man. I love real estate as you do, and I love the financing side of it. I got started pretty early on and was attracted to the financing side almost immediately. So the financing side is very interesting because that's how the deal is structured. So you're talking about getting something out of the ground. How do you structure the deal? So first of all, are you getting some participation from private lenders? Are you getting some participation from the owner themselves? Participation from a bank? The way you ask that question is fairly broad. So I'll give you a more general answer and then let's have a conversation about more details on different strategies there. But in general, when you're doing something like a new development, and it could be a single family house, which is very easy, right? I know that you are participating in, which could be much larger than that. You need to decide like how much, I guess what I should say is you start with your first lien position. So let's say, well, who's going to be your construction lender? And then what are their requirements going to be? And if they're going to require some down payment, where is that going to come from? Do I put together a little offering? Is it a friends and family? Is it more of a syndication? Or can I get the owner just to throw in some of the equity? So really it starts with the first lien position lender, and then you go from there. Does that kind of helps get us started?
Yeah, that's perfect. I was just talking to one of the financial institutions that I'm working with, and we're working on a large project that's a 300 unit apartment
Yeah.
building. And what we're considering is exactly like that. We're trying to figure out, well, how much equity do we need? I mean,
Yeah.
from experience, we kind of know the ballpark. But then over the last few years, we've been looking a lot at HUD financing, which is
Okay.
basically government financing of projects. And it's cool because it's construction to perm. So you get one loan to build and the same loan continues on its interest only during construction phase. It converts into a 40-year amortized loan thereafter. The advantage why we were attracted to that is we thought with that loan, we can increase our leverage, borrow more money from the government at low interest rate, and then bring in less equity. It didn't turn out that way. When it was just sized, literally 30 minutes ago, I got this email. It got sized, and it turns out all of the parameters put in there, the equity requirement was about the same. It still has advantages, but same as going to a traditional bank debt. But when I first started in the industry, that was exactly the first question I asked is, okay, well, my first project wasn't that big. We figured out what the cost is going to be and went to the bank that we normally would have banking relationships with. Let's just say 70%. Our loan to value is 80% or 60%, whatever the number was. So you have to figure out how much equity you need.
Mhm.
In today's world, we're noticing that there are multiple options there. There's private debt, there's bank debt, there's
Yeah.
government debt, there's mezzanine debt, then there's all kinds of equity positions. My understanding is that you are involved in private debt and private equity side of things. Is that right?
I do some private equity investing personally, so we can talk about that. But as far as Pine Financial and what my primary focus, we're senior position lenders only. We're value add bridge lenders, so we don't do a ton of new development. Our new development and where I have my experience is really infill, like small stuff, 1 to 4 unit type of thing. Some townhome complexes, but it would be rare for us to see something over, say debt of 5 to 6 million bucks. And so what you're working on is I'm familiar with it. It's just so much larger, right? When you start talking about 300 unit apartment complexes, the benefit there, Eugene, as you know, is you do have some government options. If you're developing a storage facility, for example, you're not going to get Fannie or Freddie to be interested in that, right? So you have to go community bank or commercial bank in those scenarios, and you're going to have bigger down payment requirements. They're also more flexible, so they're going to be more lax on where that equity comes from. And you could potentially bring in some mezz debt to cover that equity. It's very unusual, but some lenders will look at mezz debt, which is basically just subordinate, as equity, and have a lower loan to cost. So again, you really do need to focus in on that senior lien holder and have some open and honest conversations with what the requirements are. It could change. That's why we say if you're raising capital, I would strongly suggest oversubscribing it. That way you can handle the changes in the bank requirements and you have some liquidity for reserves. So be prepared for changes in your financing as you go through the project.
Yep. So the typical chicken and egg, what do we need to
Oh,
find
man.
first, debt or equity? It's still chicken or egg in here because we do smaller projects as well, not just these $100 million big apartment buildings. But a lot of times we would come to a lender saying, hey, here's a project. What do you think? And especially in the last couple of years, they tell us, look, don't even talk to us until you raise all your equity.
Oh, yeah.
A lot of the equity participants say, well, do you have your debt secured? Because we don't
Yep.
want to waste our time unless you have your debt. And so here we go. But so tell me, why would somebody go to a private lender? I would imagine you're more expensive
Yeah.
than a commercial bank. What's the advantage?
Well, there's lots of advantages, and a lot of it comes down to math. So let's get into math in a minute. But first of all, it's much easier to qualify for and a higher loan to cost ratio. So if you get someone like Pine Financial and you're going to do just a little infill spec home, let's say, it's possible to borrow 100% of your costs. You have to be at 65-ish% of the completed value, and you're going to have to go through the construction draws, just like you would with any construction lender, to make sure that you're getting to that completion. You could potentially eliminate the need for equity. So big benefit there if you're doing quality deals is you're not sharing some of the profits, right? So and that's where it gets to the math, what I was alluding to. I would run different scenarios in a spreadsheet of some kind. I could stack the capital in this scenario. I'm going to have a 60% loan to cost with this much mezz, and the rest is equity that I raise in a private offering, let's say. And that's scenario one. And then scenario two, this is a higher leverage lender, a little bit more expensive. I'm going to eliminate mezz. I'll just bring in friends and family, and this is what they're going to charge me. And maybe go to 3, 4, 5 scenarios and see which one works out the best. Because each deal could be different as far as profitability, depending on how you stack that capital.
Okay, so you said something interesting. It is actually possible to borrow 100% of your project cost?
Now, it's going to be like smaller stuff. And you got to be willing to work with like a really niche lender like us. Now, we're geographically focused, right? So, I mean, if you're in a good neighborhood in Denver that we know really well, then yes, potentially finance 100% of your costs. In fact, we do that frequently. Same thing in Minneapolis where we do a lot of business. But we're not going to do that deal with somebody outside our lending area.
Okay, so how do you protect yourself and your investors? Isn't that extremely risky?
Yeah, I hear that all the time. And it appears that way when you say, oh, no money down. But do you know that VA loans are one of the lowest default rates of all types of loans? And what's the down payment requirement on a VA loan? Zero.
Zero.
There's no down payment requirements for VA loans. The reason it's got such a low default rate is because there's other factors that are more important than down payment in the underwriting. So, for example, they have low debt to income ratios. They only make loans, the VA only makes loans to veterans that can actually afford it. Now, FHA, for example, they have a really high debt to income ratio. It's over 40%, which is far too high, right? But they're still going to give people money to go out and buy more house than they can afford. And so in return, they have higher default rates, close to 10% default. I think there's less to do with the down payment and more to do with, for us, quality of the deal and quality of the sponsor. We require personal guarantees. I know when you're getting into the range that you guys are working in, Eugene, a lot of times you can get away from personal guarantees. But in the small residential world where I play, you can't get away from them. You will be guaranteeing the debt. And then we do the construction draws. I want to be at 65% of the value when it's complete. I want to go through a title company. I want to make sure that their quality inspections, quality draws where it's going to only reimbursements or paying contractors directly for work performed. And that's how we protect ourselves. And if money gets out the door, like for materials and materials start leaving the job site, that's where the 65% loan to value comes in.
Okay, so with somebody who doesn't have a lot of experience, maybe developing their first property, and it could be a house, it could be a townhome around here in Western Washington, ADUs and detached ADUs have been extremely popular
Yeah.
in the last couple of years. People that are building those are a lot of times just regular homeowners with full-time jobs who wanted to maximize the value of their real estate. Would a project like that be a candidate for you? And then would you loan to somebody like that who's never really developed anything before? Maybe they hired an experienced general contractor to build it for them, but what would be the parameters?
Yeah, that's where the private lending industry becomes a bit more challenging because we don't have this little box like the GSEs. We can be creative, right? So each deal is going to stand on its own is really the best way to answer that. Or like the attorneys would say, it depends on the deal. But
Right.
the real answer is we probably won't do 100% loan to cost on a first project for somebody. We would likely want to see them bring in a partner that has the experience, has been through, a handful start to finish, which again, when you're bringing in a partner, even if they're not injecting capital, you're still probably sharing some of the deal. I would say greed is one of the biggest mistakes investors make. I would say definitely it's worth sharing profits early on in your career to get a good solid foundation and the relationships you're trying to build.
Let's talk about creative finance. And I hear that term all the time, and
Yeah.
especially recently when banks seem to not be willing to lend, when a lot of private equity is sitting on sidelines. What does that term typically mean? And what part do you play in that?
Yeah. So I think creative financing is anything that's non-traditional. So when I think of traditional funding or financing, you got your 25% down payment, and the rest comes from an institutional lender, right? That's very vanilla. So anything outside of that, I would say is creative. So it's a vast definition, right? But I'll give you a quick story here. When I was starting out, I was broke college kid. I didn't have any money, but I was still buying a house or two houses every single month. So I would get questions constantly. How in the hell are you buying properties with no down payments, no money, not very much credit because I was so young? How are you doing it? Well, the reason I was able to do that is because of creative financing. So I would find sellers that were in the exact right situation for me to help them. Usually it's alleviating two payments, right? Because that will take them down. They've already moved on and now they have a vacant house they're making payments on. So that's really the ideal candidate there. And then we were able to take over their payments, take a property subject to their existing financing, or we would lease it with a right to buy sometime in the future. Now we could unpack both of those strategies a little if you'd like for your listener, but it's really just getting the seller to participate. And look, they don't ask for down payments if you don't offer it. I mean, these are people that are motivated and you could help solve their problem. So that's how I got started. Now, fast forward, I got into the private lending industry. So I started raising private capital and I started like syndicating notes, right? It's like bringing three different people to fund one note. So you start talking about fractionalized notes. That's a pretty creative strategy, right? That I would put in the bucket of creative financing as well. So it's such a hard question to answer, Eugene, because it could be almost anything. There's
Right.
thousands and thousands of ways to fund real estate transactions. It's literally open to your creativity and what you and the seller both will benefit, how you can both benefit from the transaction.
Right. So there's no one sort of prescriptive rule. I recently defined the origin of real estate developers. I was having this conversation and I'm like, you know what? I think developers are really born out of two different paths. One is an institutional developer that's existed for years. They have this big firm, their structure, management, their rules, and that's what they do. And then the other one is somebody who owns property or got a hold of a property somehow and then decided one day to build something on it.
Yeah,
And that turned into a business. And I'm sure the institutional guys got started by being that first group
probably so.
because nobody just wakes up one day and says, I want to be a developer. And
Yeah.
so then when you kind of organically end up in this industry, you start figuring it out. Well, how do I get this done? And of course, the most common thing people know about financing deals is you typically have to have in your bank account, and then you have to go to a bank and borrow some money. But what I learned quickly is that banks typically don't loan money to people that really need money.
That's right.
So we're in this kind of interesting world, and especially right now in the last couple of years, interest rates have gone up. But there's been a lot of talk about a huge tsunami of defaults that's coming down. I haven't really seen it materialize. There's been quite a few, but not as many has been forecasted. What is your risk outlook by looking at the real estate market in the next, 12 to 24 months?
Yeah, I think each asset class has a very different exposure. So give you a great example because you're in the multifamily space. So you've seen this happen. There's been a significant softening in that space. And the reason for that is, well, twofold. One, it's a pretty attractive asset class. So there's a lot of people trying to get in and they've been overpaying for properties, right? But two, cap rates. So you had cap rates being artificially held down because of stimulus. So you'd see cap rates in good markets floating around 4, maybe 5%. Is that kind of what you've been seeing, 4 to 5% cap rates in the multifamily space?
Historically, yeah, in the last few years, it's definitely been spiking up to
It's fine.
6.5 recently. But what we've noticed is the high cap rate deals don't typically trade unless they absolutely have to. So especially in the urban markets where we typically are, if a property could be trading at 4.5 cap rate 2 years ago, and today it's being offered at 6.5, the seller, if they can help themselves, they wouldn't sell.
That's exactly right. And that's part of why the cap rates have been compressed.
Sure.
Yeah,
It's
so
educational.
yeah, my understanding of the cap rate, and you tell me what you think, Eugene, if this is a good way to describe it. But if you have no debt on the property at all, what's the return going to be? All of your income minus all of your expenses, it gives you your net operating income. And so your cap rate is your return on investment, assuming there's no debt. Now, it's a bit more complicated than that because you use its value and everything, but it's really just paying for a return. So you say a 4 cap, that means if I bought a house for, let's say it's $100,000 and it's a 4 cap, then I'd be getting $4,000 return, net return, right? That's 4%. Is that a good way to describe it?
Yeah, that's pretty much my finance background. I always describe it as the discount rate of perpetuity. So
Okay.
if you were to receive that cash stream forever, what is the present value, today's value of that infinite cash stream?
So a 4% cap would be a $4,000 return, right? So if I want to buy a $4,000 annual return, pay $100,000 for it. But think about what you just said. If it goes to 6, so what does that do? That to get that? Say if that property is producing $4,000 annual, and I went from a 4 to a 6. Now, what is that property value? What happens to that value? I can't pay $100,000 anymore because that's a 4% return. I have to pay much less to get a 6% return. So it's an inverse relationship, cap rates to values, right? So as you see cap rates go up, you see a drop in values, and that's the softening we're talking about. Now, 4% or 4 cap that you've suggested has been kind of sticky. The treasuries are higher than that. So that's why I was a bit nervous about the multifamily space and the fact that you were borrowing debt at between 6 and 7%. So you're actually have a negative leverage situation. So I thought that there was some significant exposure in that space. Other asset classes, office, for example, you saw a dip pretty quickly after COVID, but the cap rates went up and they were kind of hung up there. So you were buying them at probably fair cap rates. Right? So there wasn't a lot of risk in that space, in my opinion. Storage, everyone needs storage. So you're not seeing a lot of movement in values. Now coming to the single family, when you hear crash, you hear foreclosures, and you hear lots of inventory coming, typically people are talking about the single family residential asset class. I don't see it, Eugene. I'm curious what you're seeing, but even on a national scale, we have an inventory issue. There's just frankly not enough housing. And we have record levels of equity. And that was created artificially with stimulus, right? So we had rapid appreciation on homes ever since COVID. We had really low interest rates. So when you look at an amortization schedule, more of your monthly payment is going to reduce principal. So you're creating this spread. So that's what's creating all of this equity. And equity gives homeowners options. They're not forced to sell it. They're not going to be forced into a foreclosure. They could refinance, they could sell if they need to instead of the foreclosure. So I'm not seeing a lot of risk in the housing asset class.
Yeah, I would agree. And I'm not really seeing a lot of typical recessionary trends like unemployment. We're not seeing huge layoffs around
Right.
the country. And as long as people are able to pay their mortgage, we should not be seeing this huge spike in foreclosures. Most mortgages, I think, after the GFC are based on fixed rates. During the COVID time, when the mortgage rates were practically, people were getting their refinances at 2.5%, 3.5%, they're sticking to it.
Yeah.
And those were based on fixed rates. So yeah, I would absolutely agree. As long as major employers are still hiring, and around here in Western Washington, we still have Amazon growing like crazy, Microsoft's expanding, Google's moving into the area fast, and all of those big tech employers. Boeing has their own thing going on there. But regardless, there's still a shortage of housing. So between single family duplexes, smaller townhome developments, and larger apartment buildings, fundamentally strong demand once things kind of shake out.
There'll always be demand in multifamily. There's just too much institutional capital out there that likes that asset.
Right. In terms of cost of money for somebody to borrow from a private lender like yourself, what should I expect to pay? I'm presuming it's going to be more expensive than a bank.
Yes. Yeah. Hard money, like it's hard money, right? And that has such a negative annotation to it. Like people freaking hate hard money. But
I
like we
stopped saying
just,
hard money. I started saying private money because
yeah,
hard money just sounds scary.
it sounds scary, but I've been in the hard money lending space for 18 years. But I got to tell you, that's all we knew it as back in the day. Now people want to change it to private lending and private money because it sounds better, but it's the same thing. It's more expensive. But how much is your partner? And I got to tell you, you don't use a hammer to drive in a screw, right? You use the correct tool for the correct job. And hard money or private lending or whatever you want to call it, I just consider that a tool in the investor tool belt. As I mentioned, if you want to look at 4 or 5 different scenarios on how you're going to stack your capital to fund your project, hard money should probably be in 1 or 2 of those scenarios. And maybe it's a good tool to use and maybe it's not. Each deal could be different, right? But it's not just for bad credit and no income documentation. Good quality borrowers, very sophisticated, experienced investors use it.
Right. That makes perfect sense. In my experience, and I've used private debt before, I appreciate private debt for typically the speed of underwriting, the
Yeah.
speed of closing, because I can usually get private loan, depending on the size, of course, a smaller size loan, sometimes even as fast as a couple of weeks. Larger loans, maybe a month, whereas a commercial bank could easily take 3 months.
Oh my gosh, dude, we are trying to refinance this little retail center that I'm involved in. It's got some great leases. Ace Hardware just came in and signed a big lease, and it's so bankable. This is a no-brainer. And there's 4 sponsors. All of us are signing on the deck. Great balance sheets, all of this. We're 2.5 months in, and we still don't have it done. What in the heck is going on? I mean, do we need to go to a different bank? But you don't want to start the process over. We have bridge debt in place. We got to get this refinanced. So I hear you, man. It's wild.
Well, and it's a lot of times it's hard to quantify, and inexperienced developers don't know the cost of their money when they're working through that. They compare private debt at, I don't know, 12% versus a bank debt at 8-9%, and they're like, oh, I'd rather get a construction loan from a bank. But the time that it takes, if their permits are approved and they want to start construction, and it's, I don't know, month of May, the cost of the money could be substantial. Not even talking about property tax and holding cost, but if they don't start construction by, I don't know, end of June, they might miss the summer start cycle.
Good point.
And you don't want to start construction in Seattle in September, because middle of September it starts raining and it doesn't stop until middle of next June.
I've heard.
We
Yeah,
we
so
made
that's
that
your
mistake.
that's your finance mind right there. Look, time value of money. And you're right, that is overlooked frequently. But not just on the closing. Think about your draws too. Like I've seen or heard of contractors leaving projects because the draws just take way too long and they got to feed their families too. Right?
Right.
So when they submit their invoices, and these are good contractors like with one draw a month kind of thing, and they're not getting paid for 2.5 weeks. I mean, that can create a problem. That slows your
And
whole
it's
project down.
and then it's a chain reaction. It's a snowball effect. Once one of your trades get delayed, it triggers all the other trades, and a week or two delay on completing your electrical might mean that your insulation, your drywall, everything else get delayed.
Yeah.
And then once one trade demobilizes, it's going to take them time. And then the new trades already had you in the schedule. With residential, that's why I like commercial construction, is everything's a lot more scheduled and a lot tighter. In residential, a lot of deals are handshake deals, and the schedule, even though it might be on paper, it's still sort of assumed that you're going to be okay if it slips. Whereas in commercial, there are serious repercussions for schedule slips.
Yeah. I guess the only repercussion in residential is to the owner or the developer, right?
And it's hard to enforce because there's schedule is one of those things. Even in commercial deals, schedule is one of those things that is really hard to enforce.
Subs typically don't get along so well. So no, it's not my fault. It's his fault.
Well, yeah, it's our human nature. We like pointing fingers. And so when you do, presumably from what you said, your draw process is fairly straightforward. Do you do your own inspections? How do you know if the draw request is accurate?
Yeah. So if we're doing a little fix and flip, which is primarily what we do, we're going to do our own inspection and issue draws. You're looking probably a couple of days to a week from start to finish. A lot of that depends on this scheduling of the inspection. On the construction side, it's a bit more complicated because usually the draws are bigger. You have the title company with the lien waivers. There's some more hoops to jump through, a little bit more formal. So once a draw request comes in and approved by our office, then it goes into inspection, and you're probably looking at 2 weeks or so. Maybe it's not quite that long, but it's getting up there because of the inspection.
Right.
And here's what I find, Eugene. The developers don't always have their shit together. So do you have all of your invoices? Do you have, okay, you send me this credit card statement with all of this stuff, but I don't know what this stuff is or where it's going. So we have to identify and document that. And no, we're not paying for your paint sprayer that you lost. Right? We're paying for stuff that we into adding value to the project.
Right.
Yeah.
What we notice is, especially with smaller subs on smaller projects, that's always seems to be the endless hunt. They send you an invoice and then you're like, okay, I need your conditional lien waiver. I need your unconditional lien waiver from the previous draw.
Do you guys ever do the stamp on the checks when you pay your contractors? And when they endorse the check, they actually waive their right to a lien by endorsing the check?
Not anymore, just because most payments are electronic anyway. They're all ACH. And what's interesting is that some lenders would not accept electronic signatures on lien waivers. They require a physical wet signature with a notary. And that's when it becomes difficult. With electronic, maybe it's our state difference, but with a notarized unconditional waiver, if there was ever a lien filed, you could literally bring it to the recorder's office and they will record the unconditional waiver with notary stamp. Otherwise, you have to go to court.
Yeah.
And so it's a process.
Yeah. So you're talking about when the final payment, you're done, you're off the site. That's the lien waiver that you get notarized.
Because the lien waiver, unconditional lien waiver, even if it's a progress payment, it would say, this is the amount that I've invoiced, this is the amount that I've received, and I unconditionally waive my lien rates. And that gets notarized, signed, and notarized.
And that's just accepted in the industry, I guess. In Washington, that they have to go figure out the notary on their own and get all that over to you.
Exactly. I mean, we would normally have a notary on staff, like if it's a really small sub, that they could come to our office and we would notarize it. But normally, yeah, they would have it figured out.
Oh, that's very interesting. I guess on my projects, I still put the stamp on the check.
Yeah, well, with electronic payment too, it's easy to prove. Here it is. There's proof of payment.
Yeah. But even when they cash a check, it still shows up, right?
Anything else you'd like to add, Kevin?
Well, I just think, I do want to say this. We talked a little bit, Eugene, about the market and what's going on with the market. And we had some pretty general comments there. And I wasn't sure if I was clear enough that real estate is very localized. I'm sure you got a pretty sophisticated listener base, so they probably already know this, but I just want to be careful here that not every market is going up. Not every market isn't going to see softening. Some have been overbuilt and some will see some correction. So it's very localized. What you and I were talking about is very much more macro. So I just want to make sure that that was clear. And then, look, we don't really know what's coming in the market, right? No one has a crystal ball, but we do learn from the past. And I went back through all the recessions and I tried to find the ones that impacted real estate in a negative way. It's not very many. 2008 being one, which this doesn't resemble that at all. And then 1990 was the one before that. That one does resemble what we're going through now because it's coming out of the savings and loan. There was a war, so there's tons of government stimulus. We had super high inflation and high interest rates. So it does resemble what we're going through. So I studied that recession. So 1990 recession and tried to compare what we're seeing today. And I think it could benefit real estate investors. So I just wrote a report about it. And I'm giving that report away for free to anybody who wants it, just a PDF. So you got to nerd out on it a little bit. But if it's okay, I'll share the website on how to get that for free.
Yeah, we'll put it in show notes too.
Okay. Yeah, it's thepinereport.com. There's two reports in there, but the one that I think will benefit the listener the most is that recession one.
I'm curious to read it myself.
Otherwise, man, I just appreciate you having me on. It's always great to talk to you.
Thanks for being here, Kevin. Appreciate your input. Your last point about the localized economy for real estate, absolutely important to know your own market. The reason I like real estate is that typically, historically speaking, even with all the recessions, declines, and real estate still keeps growing. So it's still an excellent investment opportunity. And I think very important to have in any portfolio.
Yeah, I agree. Just go to the Fed. It's Fred, the St. Louis Federal Reserve. Just type in Fred into Google and you'll find it. If you go back through all the recessions and look at housing median value nationally, you will see that housing typically goes up in value in recessions. It's very interesting. And it's something a lot of people don't quite understand.
Real estate development.